Assalamualaikum warahmatullahi wabarakatuh. I'm AMIRA IZYANI binti NAZIR from Microeconomics PET3023 Group A. So today I would like to show you guys about our website. This is what we have done in the website. First of all, this is our cover page. Our cover page include the login and logout button for students access the website easily. Next, the content page. In this content page, students can easily click the icon to go to the respective page. Next, in home page, we have written about the acknowledgement and also about the team members. I would like to introduce my group members, which is me, AMIRA, THAMAYANTHI, HUEI, MYSARAH, FARAH and AZREEN. Next, we are going to move to the introduction page. In this page, we have some explanation on demand and supply, and also our topic, which is consumer supplies, producer supplies, and market efficiency. Now, I'm going to show the main page of the topic we choose. There are 3 pages of the explanation with point for this topic. Firstly, we are going through consumer supplies. What is consumer supplies? Consumer supplies happen when there is a difference in between price you pay and the value you put on the product. The next slide is student can learn about how demand elasticity affect consumer supplies. Next, the calculation of the consumer supplies, which is the consumer supplies equal to the maximum price willing to pay minus actual price. Next, student also can look the example and graph of consumer supplies. And lastly, the importance of consumer surplus. The consumer surplus refers to the utility that consumers receive from a transaction. Not all consumers will purchase the product, but those with a large surplus will. The price they pay is much lower than what the value. So the consumer surplus can be seen as a good thing because the consumer will keep coming back as they achieve a benefit when they pay.
Hi everyone, my name is NURUL HUSNA. I'm the presenter of this group, so I will continue with the next topic, which is producer supplies. So in this chapter, we will learn about what is producer supplies, how to calculate producer supplies, example and graph of producer supplies, and what is the importance of producer supplies. So, what is producer supplies? Producer supplies is the excess of what a producer is paid and the minimum price he or she is willing to sell. It also can be defined as the amount a seller is paid minus the cost of production. For example, if a firm would sell a bottle at 3 ringgit while the market price is 6 ringgit, the producer supplies would be 3 ringgit. Next is how to calculate the producer supply. So the first formula is market price minus minimum price to sell times quantity. So this is the example. If the producer is willing to sell the bottle at 3 ringgit while the market price is 7 ringgit, how to calculate the producer's supplies if they manage to sell 3,000 bottles per month? So the calculation should be 7 ringgit minus 3 ringgit times 3,000. So it will equal to RM 12,000. Another formula is 1/2 times PS times OP minus OQ. So what is PS? PS is the quantity sold at equilibrium. So as we know that equilibrium is when demand and supply curve is at intercept. The price and the quantity is at intercept. So we will take that quantity at equilibrium and that is the PS. So what is OP? OP is market price and OQ is the minimum price to sell. So we will look at the next example and graph for this formula. In this graph, the supply curve shows the seller willingness to sell at each units of bottle. Assuming that the equilibrium price or PI is RM40, the sellers are willing to sell 2 bottles. And the area of the triangle, which is the blue shaded area, is the producer supplies. This indicates that the sellers are willing to sell at a lower price, but the actual paid is higher. So at the equilibrium price of RM40, the producer supplies is RM40. So this is the calculation, which is 1/2 times 2 times 40 minus 0. So it's equal to RM40. Lastly is what is important of producer surplus. Producer surplus is important because it's counted as the additional profit of what they sold, because producers are able to gain more when the price they receive in the market is higher than the minimum price they supply for. In short, it is reward for the producer because it's cover the cost of productions. And we will continue to the next subtopic, which is market efficiency. In this topic, we will learn about what is market efficiency, the level of market efficiency, example and graph of market efficiency, and why is market efficiency is important. Market efficiency is a relatively broad term and can refer to any metrics that measures information dispersions in a market. An efficient market is one where all information is transmitted perfectly, completely, instantly, and for no cost. Asset price in an efficient market fully reflects all information available to market participants. As a result, it is impossible to act and make money by trading assets in an efficient market. Market efficiency does not say that the price of an asset is true price. It is only say that it is impossible to consistently estimate whether the asset price will move up or move down. There are three levels of efficient market, which is weak, semi-strong, and strong. What is weak? We assume that current stock prices reflect all available information and that the past price performance has no relationship with the future. Next level is semi-strong. Stock prices have factored in all available public information. Because of this, it's impossible to use fundamental analysis to choose stocks that will beat the market's returns. And the last level is strong. Essentially assume a perfect market and isn't plausible when there are insider trading restrictions. This is the example and graph of market efficiency. So we can see there are the price of concert ticket and the quantity of concert ticket. So we take a look first. The economic efficiency tells that allocations of resources maximize total surplus, which is consumer surplus plus producer surplus, which received by the society. So where is the consumer surplus? From the graph, we can see the area above the equilibrium price and below demand curve is called as consumer surplus, and the area below equilibrium price and the above supply curve is called as producer surplus. So the equilibrium price is 40 ringgit as we can see, and the equilibrium quantity of concert ticket is 2. So when we want to calculate the total surplus is consumer surplus plus producer surplus. Next is the importance of market efficiency. It is very important for investors because it allows them to make more sensible choices. The only real way that they can get above average profit through investment in this different market is by taking advantage of any abnormalities when they occur. When the market is running efficiently, it will not possible for investors to make above average profits, but any abnormalities can be exploited. Over time, these abnormalities tend to be removed, but while they are there, it is good time to take advantage of them. The good news for investors is that there are many economists who argue that there will never be full market efficiency, so there will always be a way to get an edge. So the purpose of this assignment and this topic is to encourage us to learn on how to create a website innovatively and creatively on the learned topic. And it also can identify what is the importance of market equilibrium for the consumers and producers. It can be concluded that the equilibrium is the state in which market supply and demand balance each other, and as the result, the price becomes stable. The equilibrium price is the price where the plans of consumer and the plans of producer are agreed to pay and agreed to sell. And it is also about the quantity demanded is equal to quantity supplied. That's all from our webpage for topic consumer supply, producer supply, and market efficiency. Now you guys can go to log out, and we hope that the student who are accessing this interactive webpage can improve their learning experience. Thank you.